Investors already beginning to think about their 2025 strategies, and our guest says we should think about leaning into cyclicals, companies that tend to do best when the economy is doing well. We're joined by Matt Orton, Chief Market Strategist at Raymond James Investment Management. Thanks very much indeed for joining us.
Great to see you, Andy.
When I think of cyclicals, I always think of chemical companies, maybe industrial companies, car makers. Am I along the right lines there?
Yeah, you are. And I think a lot of investors tend to only think of those more industrial machinery-based companies. But, cyclicality really means just leaning into the more economically sensitive parts of the market. And one of the biggest economically sensitive parts of the market is financials. And we've been knee-deep into financial earnings over the past week or so in the US, and the results are really, really good. We have I would say, a very solid economic backdrop. We're clearly seeing a reversal in capital markets activities. We're seeing a pickup in banking. We're seeing a pickup in trading. Volatility certainly helps that. And in addition to that, we're seeing those generally more heavier parts of the economy like industrials, materials do well. But like you were talking about before, Andy, there's also part of cyclicalities leaning into artificial intelligence, the electrical equipment companies that are needed to cool down data centers, the physical plant and equipment that's needed to build out the data center and power plant growth. So there's a lot of opportunities within that cyclical bucket. And when I talk to clients, I say, don't abandon the tech trade, but keep some of the high quality tech names, but you can actually start to feel very confident leaning into those more sensitive parts of the economy, and valuations, I would argue, still look very attractive.
What about financials? We've generally had some pretty good earnings from the big US banks.
Yeah, the bank earnings have been really encouraging. And so expectations for banks were actually one of the most negative parts of the financial sector heading into earnings season. So, in a note to clients earlier this week, I was saying that I really think we have the opportunity to have a significant beat on earnings season this year. Consensus is between 4 to 5%. I think we can be north of 7%, in part because of the strength of the financial sector. It's been very, very strong so far this year. So you need to be careful about what you own, but owning higher quality banks that are turning around really solid ROE numbers, seeing an expansion with respect to capital markets activities, those look very, very attractive. And a huge area of growth is also, call it the private markets, alternative assets. So financial companies or capital market companies that have exposure to that business, I also think can continue to do very well. So I've been telling clients that financials is a part of the market you can feel confident leaning into, I would say, into the rest of this year and into 2025.
What about small caps? You say there's yet to be a decisive breakout in that group of stocks?
Yeah, Andy, I think there's been some impatience on the part of many clients because once rates got cut in September, I think the expectation was that you were really going to see small caps start to take off because of the enthusiasm around their balance sheets, variable rate debt being refinanced, and you just haven't seen the outperformance down market cap. Now, today's been a very solid day for small caps, but I think there's a lot yet to come. And I think earnings are going to be the key piece of that. My expectation is that we finally start to see a reversal and downward earnings revisions for smaller companies. That, I think, gets investor enthusiasm up. We already have historic gaps between valuations of small caps and large cap companies. Again, they tend to be more cyclical, more heavily tied to the fate of the US economy, which is doing very well. And financials are a bigger part of small cap indices. And as we see regional banks start to turn around, I think the picture looks very encouraging. And small caps are still so cheap. So I've been telling investors that if you don't have exposure down market cap, which many investors don't, now is the time to start picking it up because the risk reward looks very, very favorable.
You started talking about the AI and software companies, hardware companies aren't the obvious way. One popular trade right now is electricity generators.
Yeah, it is. I almost call the next wave of artificial intelligence outside of the semiconductors and some of the big hyperscalers we've been successful so far. I call it an AI 2.0 basket. It's what are the tangential plays? What are the next plays on artificial intelligence that are going to be necessary to realize the future state of where we need to go? And that's more data centers, a lot more power to let these data centers actually operate. So the investment in utilities, fixing the electrical grid, both in the US and Europe and in other places around the world. Those are all top priorities, and those are bipartisan priorities too. So I think there's a long runway for those trades to play out. So even though some of the gains across what's usually a sleepy, more defensive part of the market, like utilities, that can make people uncomfortable. But I think there's still a long way to go.
It's certainly amazing, isn't it? I mean, we've already got a vast data center industry, but it looks like it's going to be bigger and bigger. Apparently, even the galvanizing people are excited. I learned this yesterday because a lot of these centers are in remote areas and they need to be rust protected, the buildings themselves.
It's amazing. When you peel back the onion of artificial intelligence, there are so many more opportunities for investment as you think about it. And so that's why I say we need to be looking at the enablement of artificial intelligence going forward. So when you talk about the galvanization, also just think about the electrical cables that are going to be required to connect those data centers. What do you need for that? You need copper. So not only is copper a China potentially related play, but it's also a play on data centers and more electrical grid upgrading that's going to have to take place over the next 3 to 5 years. So there are so many opportunities that might not be immediately apparent in technology, software, or semis that I think are very directly related to artificial intelligence. And again, that fits in industrials, that fits in materials and utilities, different parts of the market. So you can build diversified portfolios. And that's really exciting for me as an asset allocator going forward.